You've been talking to a lot of people here about heading off to China. You're going to be looking for what from the Chinese? Is this their last chance, this delegation, to prevent tariffs?
Well, I'm looking forward to very frank discussions on the trade issues and to continue those discussions and see if we can reach a mutual solution to this. I think the good news is President Trump and President Xi, since Mar-a-Lago, have been talking about the trade imbalance. President Xi acknowledged that our objective is to have a more balanced trading relationship. I think the two presidents have a very close relationship, and I'm going over there with our large economic team to see where we can get.
If I were the Chinese, though, and I were listening to that team that you just described, it's going to be you, it's going to be the U.S. Trade Representative and Advisor Peter Navarro, often hear rather different things from all of them.
And Larry Kudlow and Secretary Ross. But
so if I were, should I be listening to you if I'm the Chinese trying to prepare for these conversations, or listening to Peter Navarro? Is there a united front between you?
You should be listening to all of us. So what I would say is we have a terrific economic team. We meet almost daily on these issues. We meet with the president regularly. I think it's good to have a diversity of opinion, and when we go over there, we will have one voice.
And what is success? What is success? When you're on your way back, what is success?
I think you'll know it when you see it.
Well, of course, before then, we're a few hours away from potentially that exemption from the tariffs, the steel and aluminum tariffs, expiring for the European Union and for a bunch of other countries. Can you tell us where you are on that? When are we going to get a decision?
Again, I expect you'll see a decision later today from the president. We had a good meeting of the economic team with him, talking about these issues, and I'm obviously not going to get ahead of the president on his announcement.
But I think people listening, I mean, we know that the European Union, they're certainly saying that they're resigning themselves to not getting that exemption extended, and they have a very clear list of retaliatory tariffs that they have for themselves against U.S. exports. Are you modeling that at Treasury? You must be thinking about the impact on the U.S. economy.
You know, again, what I would say is we've been having very good discussions with our counterparts. I was at we had all the G20 finance ministers in Washington, D.C. last week for the IMF and World Bank meetings. We had very good meetings with President Macron and his economic team. I then went to Paris for a terrorist financing conference where I was with the finance ministers of the UK, Germany, France, and Canada. So we've been having very direct conversations over the last 2 weeks on these issues.
But as we get to these deadlines, sooner or later you don't have the phony war anymore. We actually potentially could have these tariffs. You know, how do you think about the impact on the U.S. economy if there's retaliation? We've already seen U.S. domestic steel prices going up relative to European ones in anticipation.
Well, first, let me just say I'm not going to comment on the president's decision. It will come out soon. And as it relates to any time you go to negotiate, and I use the example, 6 months ago people said we were being too aggressive on North Korea. We had the strongest sanctions on North Korea that ever put in place. Those sanctions are what got him to the negotiating table. We're at a historic event. North Korea and South Korea talking about having peace, the president sitting down with him and talking about them now being willing to give up their nuclear weapons versus 6 months ago, he was testing nuclear weapons and shooting missiles over Japan. You have to be willing, if you're going to negotiate and have changes, you got to be willing to go through with difficult decisions and having maximum pressure.
So you mentioned the sanctions. I mean, another area where we've seen the sanctions with regard to Russian individuals, Oleg Deripaska, the sanction against him actually did rile the aluminum markets because of potential impact on Rusal, the big producer. Are you any closer to an agreement on that? What would constitute him relinquishing control of that company?
Sure. So let's just step back and let me comment. First of all, we've had a very broad sanctions program against Russia for the last year under our Ukraine sanctions program. Congress passed the CATSA law, overwhelming amount. Under that, we had to write the report on the oligarchs and the political figures. We had a both classified and unclassified report. We went through a very long process. Rusal was picked up, not because we were targeting Rusal, but because we were targeting the ownership of Rusal. So we understood the impact that this would have on a lot of hard workers there. We've extended the license with Rusal to try to deal with these issues. The company has petitioned us for delisting. And I'm not going to comment on the specifics of what that would entail, but one of the issues will be selling down the majority interest.
But just to push you a little bit, because it's obviously people are concerned about what this, because it would really be for the survival of that company, whether or not it's party of this to these sanctions. If Oleg Deripaska is still some form of shareholder, but a minority shareholder, is that okay as far as you're concerned?
It wouldn't be appropriate for me to go through the exact details of what will be okay and what won't be okay. There's lots of facts and circumstances that we're discussing. The first aspect would be that he sells down below 50%. And again, we're having conversations with the company. Obviously, we found those discussions encouraging, and that's why we extended the license to allow the company to have time and us to have time to deal with these issues. Our objective was not to put Rusal out of business, and that's why we extended the license.
Well, you're the Treasury Secretary. You can comment on the Treasury market. We have the quarterly refunding announcements this week. We've already seen that the first quarter of this year was record borrowing by the Treasury. Are you concerned that we're now looking at a lot of factors putting the Treasury market in a very different place this year from last year?
No, I think the good news is the U.S. Treasury market is the most liquid and robust market in the world. And while I won't comment on interest rates because I respect the independence of the Fed, what I will say is the market, the forward curve, expects interest rates to go up. How much it goes up and how fast it goes up, we'll see whether it's more or less than the market predicts. But part of the reason why we see interest rates going up is because we've created economic growth. That's a good thing. So we've been focused on targeting 3% sustained GDP. And part of the reason why interest rates have backed up is because of that economic growth.
But Bob Michael, the head of fixed income for JP Morgan Asset Management, he said on Bloomberg this morning he'd never seen as bad demand and supply conditions in the Treasury market, with so much supply coming on, and also central banks, the Federal Reserve, others running down their balance sheets. So many things coming together.
Well, let's just say again, it's a very large, robust market. It's the most liquid market in the world, and there is a lot of supply, but I think the market can easily handle it.
I think just when we think about what are the potential bumps on the road that you could have in terms of the global economy or markets, there's always been a lot of concern about how this more normal monetary policy was going to play out in the long-term yields. You see yields going to 3%. We saw markets responding to that. For you, is there a danger level that you think of? It's not 3, but is it 4? What would worry you in terms of really causing a pressure in the financial markets?
Well, let me just say I have tremendous confidence in Chairman Powell and his leadership at the Fed. And again, lots of these issues are interrelated. It depends on where inflation is. It depends on where growth is. It depends on where unemployment is. There's lots of issues that are all interrelated, I'm sure, as they look at monetary policy.
But the factors that are coming into it is that you have maybe reduced demand and a big increase in supply. That's quite basic, and that's actually independent of the Fed policy. We're not just commenting on the Fed policy. We're talking about the amount of supply that's going to be washing into it.
Well, by definition, supply and demand will equate.
Well, it could be at a very, very high rate in terms of yield.
I'm not concerned about that. I think there are still a lot of buyers for U.S. Treasuries.
Okay. If you're, what you mentioned about inflation, I mean, again, is that something, we've had some signs from the Fed, without commenting directly on their policy, that they're willing to see inflation be over target for a certain amount of time to let the economy run. Is that something you're relaxed about? Do you worry about inflation now picking up?
I think a little bit of inflation is a good thing. I mean, for a long time, the Fed was targeting higher inflation. I mean, clearly one of the aspects of the tax plan is we want wages to increase. The last 8 years have been great for the financial markets. They haven't been great for the average worker. They haven't seen wages increase. A little bit of wage inflation is a good thing. I think energy prices have the potential to, as we become energy independent, I'm not concerned about energy inflation. So I think there's lots of good signs on the horizon.
I'm interested you say that about the energy price inflation, though, because the oil price is up 65%, I think, since last summer. And we haven't necessarily seen a big amount of US supply coming on stream, as a lot of people thought it would when prices went up. They did think that the US supply would kind of be offsetting that. So are you a bit worried about what's happening to oil prices? Because that's affecting working households in the US potentially more than the tax cut.
You know, again, what I'd say is, you know, we got a lot of liquid gas, liquid natural gas. There's a lot of alternative energy, coal, clean coal. There's a lot of opportunities in the energy markets, and I'm not going to speculate on where oil prices are, but you know, when oil prices were in the 40s, people were saying they were going to 20. So I'm not good at predicting where they are, but we haven't really seen energy prices and energy inflation as a result of oil prices going up.
We have seen, I mean, one of the other factors that worries people a little bit is, you know, you can have these sanctions and other things that the administration does, which then have quite a big impact on markets in the short term. We saw it with aluminum prices, we saw it with steel prices. As we go into this Iran potential increase in or return of the full sanctions against Iran in May, are you thinking about how to lessen an impact on oil prices from that? Because that could push up oil prices.
I just want to separate sanctions from tariffs. So sanctions are very, very important economic tools that are used for national security and foreign policy. As you know, they're very impactful. That's why they worked in North Korea. They worked in Iran last time. That's why Iran came to the negotiating table. President Trump is determined that Iran won't have nuclear weapons now. They won't have them in 5 years. They won't have them in 10 years. So, again, I look forward to the president's decision on the JCPOA. But, you know, kind of that's something we're having conversations with our allies about.
But how concerned would you be about a short-term impact on the oil price? Even if you think it's justified, even if you want to push ahead with that foreign policy, you still have to think about the short-term dynamics, especially given that we've had the oil price rises recently.
It's one of the things we look at.
One of the things that we've seen also in the last few months is the trade deficit still going up, soaring in fact over the last year against the backdrop of all this trade talk. Do you really think that these sort of the trade negotiations that you have can possibly affect the macroeconomic forces that are pushing up the US trade deficit, the US so strong, sucking in imports?
Well, the president's economic plan has always consisted of three parts: tax reform, regulatory relief, and trade. Part of the reason why the trade deficit has gone up is because the economy is growing as a result of the impact of tax cuts. So that's a short-term issue, which, again, it's the unintended consequence of a growing economy. We're very focused on trade and turning that around.
But do you worry that you're going to have all these trips and you may come back with all of these bits of paper saying, we've got all these deals. Meantime, that big dynamic that you just talked about, the fact that the US is strong, it's sucking in investment, sends the trade deficit sky high.
I think if we can get the fundamental changes that we're talking about, and that's what the president is looking for, it will deal with the trade deficit.
Okay, so we've talked about oil prices, we talked about the Treasury market, inflation. There's always something that ends up causing the next recession. We know there will be another recession, not necessarily anytime soon.
Well, one thing about this is we're never very good at predicting what it is.
Well, what do you think about as being, just for you, given your experience in the markets, what do you watch as something that you think in this cycle could be the biggest risk for a recession?
I think the issue is, and again, I think in this cycle, the risks are relatively low because credit quality is very good, liquidity is very good, banks lending is very strong. So the next issue is going to be something that we don't anticipate.